Hey everyone, welcome back to Corporate Decoder. Today, DWS Global High Income Fund just filed its semi-annual shareholder report, and I am seeing some interesting numbers about where their money is going. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a real snapshot of the fund's investments at the end of April 2026, and it tells us a lot about their strategy. This is the DWS Global High Income Fund. Specifically looking at its report for the 6 months ending the 30th of April 2026. It covers the period from the 1st of November 2025 to the 30th of April 2026. First, let's talk about costs. For a hypothetical investment of $10,000, the report breaks down what it costs to invest in different share classes. For class of shares, out-of-pocket costs were about $50 for those 6 months, which is just under 1%. For Class C shares, the costs were a bit higher at $87, or about 1.74%. Class R6 shares had the lowest costs at $32, about 0.64%, and Class S and institutional class shares were both around $37, or 0.74%. These are annualized costs, meaning if you invest for a full year, you'd expect these percentages to roughly double. It is important to remember that these are what they call net expenses, meaning some fees were waived or reimbursed. The prospectus shows that without these waivers, the costs would have been a bit higher. Now, for some key numbers about the fund itself, as of the 30th of April 2026, the total net assets were almost $240 million. The fund held 291 different investments, and the portfolio turnover rate was 64%. This turnover rate tells us how often the fund buys and sells its holdings. A 64% turnover means that, on average, the fund rebalanced about 2/3 of its portfolio over the year. Let's dive into what the fund actually invested in. The biggest chunk, a massive 94%, is in corporate bonds. This tells us the fund is heavily focused on lending money to companies. After that, about 2% is in loan participations and assignments, which is another way of investing in debt. Another 2% is in cash equivalents, basically holding onto cash or very short-term investments. Then 2% is in exchange, traded funds or ETFs, which are baskets of investments. Convertible bonds make up 1%. Government and agency obligations, warrants, and common stocks each represent 0% of the fund's assets. And about 1% is listed as other assets and liabilities. Breaking down those corporate bonds by industry gives us another interesting picture. Communication services make up the largest piece at 27%. Consumer discretionary, which is things people buy when they have extra money, is 17%. Materials are 11%, energy is 9%, industrials are 8%, healthcare is 7%, and utilities are 6%. Real estate is 4%, information technology is 3%. Financials are 3%, and consumer staples, which are essential goods, make up 2%. This sector breakdown shows a strong leaning towards companies that might benefit from economic growth or are tied to infrastructure and communications. Now, for perhaps the most important part when looking at bonds' credit quality, this tells us how likely the companies are to pay back their debts. A lot of this fund is invested in what is called high yield or junk bonds. Only 2% of the fund's assets are rated AA, which is very high quality. About 10% are BBB, which is still considered investment grade. But then it jumps significantly. 53% of the fund is rated BB, and 27% is rated B. These are considered non-investment grade or high yield. Another 7% is rated CCC, which is even riskier. Only 1% is not rated. This high concentration in BB and B rated bonds means the fund is taking on considerable risk for potentially higher returns. Historically, companies with these ratings are more likely to default, especially during economic downturns. Looking at where these investments are located, the United States holds the dominant share at 61%. The United Kingdom is next at 8%, followed by Canada at 7%. France is 4%, Luxembourg is 4%, and the Netherlands is 3%. Italy, Japan, and Germany each hold 2%, and Panama also has 2%. The remaining 4% is spread across other countries. This shows a strong US focus with some international diversification. Diving into the actual investments listed in the report reveals the specifics supporting these allocation percentages. For instance, under corporate bonds and communication services, you see companies like Altus, MSC, Global Media, and Clear Channel Outdoor Holdings. In the consumer discretionary sector, there are investments in Carnival Corp, Avis Budget Finance, and Birkenstock. For the energy sector, we see Crescent Energy Finance, SM Energy, and Sunoco. In the financial sector, there are holdings in Acrisha LLC and PennyMac Financial Services. Even in the high-yield, heavy credit quality section, We see specific bond names and their interest rates, maturity dates, and values. This detailed list is crucial for understanding the actual credit risk. For example, under corporate bonds in the communications sector, you see Altus Financing SA with a 9.625% interest rate on a bond due in July 2027, valued at over $600,000. Further down, you see Dish Network Corporation with a 11.75% interest rate on a bond due in November 2027, valued at over $2.3 million. This high coupon rate on a relatively near-term bond signals the higher risk associated with Dish's credit profile. The bulk of the fund, 93.7%, is indeed in corporate bonds, indicating a strategy focused on lending to companies rather than owning equity. Within corporate bonds, communication services is the largest sector at 26.4%. Here we see holdings like Altus Financing SA A144, a bond with a 9.625% coupon maturing in July 2027. The fund holds about $609,000 worth of this bond. Another notable holding is Dish Network Corporation with a 11.75% coupon due in November 2027, valued at over $2.3 million. That high coupon rate is a strong indicator of the credit risk associated with Dish. Moving on, the consumer discretionary sector accounts for 16.4% of the corporate bond holdings. Within this, we see Carnival Corporation with a 5.75% bond due in August 2032, with the fund invested over $3.3 million. The energy sector holds 8.6% of the corporate bonds. Here we find SM Energy Company with a 6.625% bond due in April 2034, and smaller holdings in other energy-related companies. Financials represent 3.3% of the corporate bond portfolio. Investments here include Escorp Inc., with a 7.375% bond. Healthcare accounts for a significant 7.4%. For example, Bayer AG has bonds with a 5.375% coupon due in March 2082, a very long maturity. Industrials make up 6.6% of the corporate bond holdings. Transdigm Inc. is listed with a 6.375% bond. Materials are a significant sector at 10.2%. IAMGOLD Corporation has a 5.75% bond. Real estate makes up 3.9% of the corporate bond portfolio. Here we see Iron Mountain, a real estate investment trust or REIT, with a 4.5% bond. Utilities represent 5.4% of the corporate bond holdings. Vistra Corp has a 7% perpetual bond, meaning it has no maturity date. The fund also holds 0.7% in convertible bonds, which can be converted into stocks under certain conditions. Government and agency obligations are a very small part at 0.3%, specifically US Treasury notes. The fund has 2% in loan participations and assignments. This means they are buying slices of loans made by other institutions. For example, a loan associated with Assurion LLC, a second lien term loan with a floating rate tied to SOFR plus 5.25%, yielding over 9% due in January 2029. They also hold 1.6% in ETFs, specifically the State Street Spider Portfolio High Yield Bond ETF. This means they are using an ETF to gain exposure to high-yield bonds, likely for diversification or ease of trading. Common stocks are essentially 0% of the portfolio, with only a very small symbolic holding. Other investments make up 0.2%. Interestingly, a significant 6.4% of the fund's assets are listed as securities lending collateral. This means the fund is lending out its securities to other institutions and holding collateral against those loans. This is a way to generate extra income. This collateral is invested in DWS government and agency securities portfolio, which is an affiliated money market fund. This collateral is valued at over $15 million. Cash equivalents make up 1.8%. This cash is held in DWS Central Cash Management Government Fund, another affiliated fund valued at over $4.2 million. The entire investment portfolio, including all these categories, has a cost of over $252 million, and its current value is about $255 million. This slight increase from cost to value indicates the portfolio is performing slightly better than its purchase price on average. Looking at the statement of assets and liabilities as of the 30th of April 2026, we see the fund's total assets are over $261 million. On the liability side, there are significant amounts listed for payable for investments purchased, particularly for when issued securities, and also for returns of securities loaned. The report provides net asset value per S-share for each class. For class of shares, the net asset value was $6.29 per S-share with a maximum offering price of $6.59. This difference accounts for the initial sales charge. Class C shares came in at $6.32 per S-share. They have a higher expense ratio as we saw earlier, but no upfront sales charge. Class R6 shares were valued at $6.27 per S-share. These typically have lower expenses as they are for institutional investors. Class S shares were valued slightly higher at $6.33 per S-share. Institutional class shares were valued at $6.28 per S-share. The statement of operations for the 6 months ending the 30th of April 2026 shows the fund's income and expenses. Total income was over $8.3 million. Quite a bit of that from interest. Expenses totaled just under $1 million. After paying those expenses, the fund had net investment income of over $7.4 million. Realized gains on investments for the period were over $900,000. However, there was a change in net unrealized depreciation on investments of over $1.7 million. This means that while some investments were sold at a profit, the overall value of some of the remaining investments decreased during this period, leading to a net loss for the period. Shareholders received over $7.5 million in distributions during this 6-month period, which is a significant amount reflecting the fund's income generation strategy. Now, let's look at the financial highlights, which give us a per share view over several years. For class of shares, the net asset value at the end of the 6-month period was $6.29. The total return for this short period was about 2.52%, but importantly, that does not include sales charges, so the actual return to investors would be lower. For the full year 2025, the total return was over 7.9%. Looking back further to 2022, the fund actually saw a negative total return of over 11%. For class of shares, the ratio of expenses after reductions was 0.99% for this 6-month period, which is annualized. This is higher than your typical bond fund, but somewhat expected given the high yield focus. The portfolio turnover rate for class of shares was 64% for this period. This is relatively moderate and suggests the fund is not actively trading its entire portfolio constantly. The notes to the financial statements provide crucial details. One point is about security valuation. Investments are valued using various inputs categorized into level 1, 2, and 3. Level 1 uses quoted prices in active markets. Level 2 uses observable inputs like interest rates, and level 3 uses unobservable inputs. Most of the fund's corporate bonds and loan participations are in level 2, meaning their value is determined using observable market data but not direct prices for identical securities. Other investments like warrants and some other assets are in level 3. Meaning their valuation relies more on estimates and assumptions where market data is scarce. The fund also uses derivative instruments, specifically forward foreign currency contracts, to hedge against currency fluctuations. As of the 30th of April 2026, they had an unrealized depreciation on these contracts of about $117,000, meaning these contracts are currently at a small loss. This is a standard practice for funds investing internationally. A significant section discusses related party transactions. The fund's advisor, DWS Investment Management Americas, Inc., provides management services. There are also fees paid for administrative services, distribution, and shareholder services to affiliated companies. These related party transactions are common in the mutual fund industry, but investors should always be aware of them to understand the full cost structure. The report also mentions contractual expense limitations for each share class, which helps keep costs down for investors. The Board of Trustees reviewed and approved the investment management agreement with DMA. They considered factors like the nature and quality of services, fees and expenses, profitability to the advisor, economies of scale, and other benefits to DMA. The report notes that the fund's performance for class of shares was in the 3rd quartile compared to its peers over 1, 3, and 5-year periods. They also noted it underperformed its benchmark. Despite this, the board concluded that the management fees were reasonable given the services provided and that the advisor's profitability was not unreasonable. They specifically highlighted that while the fund's expenses might be higher than some peers, expense limitations were in place to keep them competitive. This section relates to the board's considerations for approving the advisory agreement, reiterating their thorough review process. The statement of operations for the 6 months ended the 30th of April 2026 shows total income of over $8.3 million and total expenses of just under $1 million, resulting in net investment income of over $7.4 million. The fund reported net realized gains of about $909,000, but this was more than offset by a net change in unrealized appreciation of negative $2.1 million, leading to a net loss of over $1 million for the period. The fund's net assets as of the 30th of April 2026 stand at $239,728,901. This is the total value of all assets minus all liabilities. The total investment portfolio valued at cost was $252,813,155. The current market value is slightly higher at $255,681,852, indicating a small overall gain since acquisition. Notably, the fund has a significant distributable loss of over $36 million. This likely comes from past capital losses that have not yet been fully utilized. For class of shares, the total return for the 6-month period was approximately 2.52%. This doesn't include any sales charges, so an investor's actual return would be less. The net expense ratio for class of shares after expense reductions was 0.99%, annualized. This is a key figure for understanding the ongoing cost of holding the fund. A portfolio turnover rate of 64% indicates the fund is reasonably active in managing its holdings, but not excessively so. This fund really emphasizes high-yield corporate bonds, which means it is aiming for higher income, but at a higher risk. The substantial holdings in BB and B rated bonds clearly show that. The board's review acknowledged that the fund's performance hasn't been stellar compared to peers or benchmarks, but they still found the management fees reasonable, partly due to expense caps in place. The securities lending activity is also a plus, generating some additional income for the fund. My biggest concern is the high concentration in lower rated corporate debt. While this can offer attractive yields, it also means the fund is significantly exposed to economic downturns or rising interest rates that could impact these companies' ability to repay. What I'm actually looking for is a clearer path to outperformance at a more acceptable risk level. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.